All right. Good evening, everyone, and good morning, good afternoon, good evening, depending on where you are joining from in the globe. Um, we have we have almost come to the end of this series, but before we end, I'm still going to do a little bit of backtrack on on what we have done so far. So maybe after this class, we are going to have one class to do like wrap up. Okay. Uh, this model this model actually wrap everything up, but then because of changes in technology, we're going to have one class to properly wrap everything up. Okay, but this if you clearly understand the content of this slide, it will go a long way to changing and altering your trading results if you take the time, take the pain, do the practice, it will drastically alter your trading results. One thing we want to do in this market is to profit from this market. But along the line, in an attempt to profit, a lot of us, end up losing. And then because of that, some are discouraged to step aside. Some don't even want to, some are not just stepping aside, they don't even want to associate themselves with anything that has to do with trading at all. But like I said from the onset of this program, if you do what you are doing right in Forex, you will make money. But if you make a mistake in your analysis, you can lose money. But the ultimate aim is that if you check your trading for a period of time, say 1 month, you'll be able to tell whether you lose money or you gain money. You're not going to make all the money one day, and you're not also going to lose all the money in one day. Okay. So we're going to be discussing a very wonderful topic today. And that topic is the 7 irrefutable keys needed to execute a successful trade. 7 keys, very important keys. If you know them, if you apply them rightly, you will just see you will see that 70 to 80% of the time your trade will be going into profit. If 70 is too high, I can bring it down to say 60 to 65. Okay, you will see your trade gravitating into the profit space if you actually do it well. And what this topic is entails is actually talking about a collection of what we have done. Okay, so we break them down into numbers. So we say uh the first key the first key is to determine if the market, the monthly chart, the weekly chart, and the daily chart are all line up in a compatible trading zone. And if the stochastic in all these time frames are all lining up in the same direction. Now, remember, there was a topic I taught you guys before we got to this point, and I can backtrack into that topic. Just 1 minute. Let me just pull it out. Time frames. Yeah, time frames. Okay. Let me just bring it up. Uh, also put it on full screen mode. Okay, so time frame. There's something I did show to you guys. I'll just scroll fast. Okay, so in this class, we talked about the monthly time frame being represented by this black line, the weekly time frame being represented by this blue line, the daily time frame being represented by this red line, okay, and then the 2 hour time frame that is represented by the green line. Now that 2 hour can be 4 hour, can be 2 hour, can be 1 hour, can be 30 minutes. It all depends on the time frame. It all depends on the platform that you are using. There are some platforms that don't have 2 hours. MT5 has 2 hours. MT4 does not have 2 hours. Okay, so if you are using MT4 to trade, you won't see 2 hours. But if you are using MT5 to trade, you will see 2 hours. But if you are using MT4 and you have an indicator that is called costume candle, you'll be able to see all the hours from 1 minute, 2 minutes, 2 hours, 3 hours. Everything you see in MT5, you can see it on MT4. Okay, so what I'm trying to say here is that in this class, we talked about all these time frames, monthly, weekly, daily, and 2 hours, all of them will start going in the same direction. Now, I want to just give you an example here. Look at this monthly, this black line is slanting to the upside, telling you that monthly is going up, right? Now, when this monthly was going up, look at this weekly here. This blue here is weekly, but it's also going up. And then you now come to the red. This daily, look at it, it's also going up. Now, on your 2 hour, what you want to do, you can even decide to say you want to put a line here on top of this place here. When the market do this pullback, by the time this market pull back from the 2 hour to the daily, you can actually put a line across this high. When the market break this high, you take a trade. That trade will run until the market get to this high before it will attempt to pull back again. When the market pulls back again, you put another line here. And when it breaks it, you take a trade. This market will run. So every movement of this market from this point to this point is our C to D movement, our C to D price movement. So our C to D, now what it means is that on this monthly time frame, if you look at it, this is D, this is D, this is D, and this small green is D for the hourly. So we are saying that we want to ensure that on all the time frames, the market is moving from C to D. So here I already know that the monthly is moving from C to D. So I look for where the weekly is moving from C to D. The market is moving from C to D here on the weekly, it's moving from C to D here on the weekly. Now, when I'm able to identify that, I will now come to the daily and look for C to D as well. So every C to D I see on the daily, that could actually be my trade if I'm taking the trade on the daily chart. If my trigger time frame is the daily chart, that daily C to D can actually be my trade. But if I'm not taking the trade on a daily chart, I want to take it on a 1 hour chart or 2 hour chart, then I need to look for a C to D on the 2 hour chart. Now, the reason why you're looking for C to D, you want to drastically avoid drawdown. You want to enter the trade, and as you enter the trade is immediately running in your favor. You know, there's a way you can enter the trade. So if I enter the trade when this market is pulling back, if I enter the trade here, all this activity the market will do during the pullback, they will not be in my favor. My trade will be negative. I will be experiencing what we call drawdown. Okay, I have to wait until that market will complete its drawdown, and then it reverse, and then it will start favoring me again. Okay, so now it goes to favor me, and it's going to favor me beyond the point where I entered, and then I'll start making profits. But if the market for any reason could not favor me, above where I entered, then I'll be in a loss. Okay, it can even go all the way to taking out my stop loss. So this is what we mean. This is what we mean when we meant when we said all the time frames are lined up and are going what in the same direction. That's what we mean. So we say determine, this is your first. So the 7 steps are there. You can see them already. Okay, but I'm just trying to put some explanation to the steps for you. So when all the time frames are lined up in the same direction, that's an indication that you are already preparing for a successful trade. Then number 2 is for you to determine what trading zone the daily chart is in, and if the stochastic RSI is moving in the same direction. So what do? If you find out the zone that the trading chart is in, I already explained in the course of our project that the trading zone, there are 3 trading zones in any chart. three trading zones. Okay. I don't know if any of us can remember the trading zone, but we have the 50-50, we have the 90-10 trading zone, we have the 50-50 no trade zone, and then we have the 80-20 push zone. I'm sure you guys can relate with this. If you can't, I can go back and break it down in 2 minutes. Okay. You want me to go back and break it down?
Yes, that will help.
Okay, so
You can
yes,
go
sir, that
back
will help.
and break it up. Because of us,
all right, no problem. I'll just backtrack now and break it down for you guys. Okay, one. Okay. All right, so let me backtrack. I will just take which course will I pick it from? That will be fast. Let me pick it from PowerFib. Let me pick it from here. Okay. So that will be fast. All right, so from the PowerFib course, I'll just go to the trading zones. All right. So these are the three trading zones that exist in the ABCDs formation. Okay. The first one I said is the 90-10 trade zone. Now, what it means, what this 90-10 means is that if you are trading from this point A to B, I want you to first of all understand that this is A, B, C, and D. If you want to look at it as a game, this is one complete game in the market. If the market moves from point A to point B to point C to point D, the market has successfully completed one of the game. And I said in a table tennis game or in a penalty shootout game in a football pitch, you want to have 3 of your best shots, 3. So if you are playing table tennis, out of the 5 games you are going to play, you want to make sure that you win 3 times. If you are playing a penalty, you want to make sure that at least you score 3. Okay. Now, if you're able to win 3 times of this game, then you will be in the money. So how are you going to win these 3 times? Is to understand the simple rule. 90-10 trade zone, 50-50 no trade zone, and then the 80-20 push zone. Now, why do we call it 90-10? You see the market between this A and B, if you spread your Fibonacci from point A to point B, when the market starts retracing, the first, which is the first of the retracement zone, is the 38.2% level. This level here, 38.2. After the 38.2 retracement level, you will drop to the 50 retracement level. After the 50, you will drop to the 61.8. Now, between the 38.2 and the 61.8, this is the most occurring in the market. Okay. Then 61.8, sometimes some people call it the golden ratio or the golden Fibonacci level. Okay. This level is the most used level in the market and is the most accurate level. Every time the market pulls back to 61.8, the market must, as a matter of necessity, move to 161.8 extension level. If you want to do a back test, go and test it on all the charts in this world. Be it Apple, be it Dogo, be it any company. Alibotin, Schlumberger, Total, go to their chart, go to their stock chart. If the market comes to 61.8, the market of a necessity move to 161.8. This is the corresponding extension level to 61.8. But because this 61.8 is like a golden level, 38.2, 50 that are above it, they are all categorized as one, in the sense that Even if the market takes off from 38.2, it will still go to 61.8. If it takes off from 50, it will still go to 61.8. If it takes off from 61.8, it will go to 61.8. But if the market comes down all the way to 78.6, it will go to 127. If it comes down to 86, it will go to 1.18 level. So you need to know all these things. Now, but the three zones we are talking about, they are happening here when the market has moved from point A to point B. What is point A to point B? Point A is a low, point B is a high in this instant. In this instant here, point A is a high, point B is a low. If I move these two guys together, it will give you the shape of a crown. If I drag this thing, if I drag this line here, and I drag this line here, if these two touches each other, when you close this bottom, this A and this D, you will have the perfect shape of a crown. That is what we call the reversal in this market. That is when the market wants to reverse, the market will create a crown shape. I've talked about that before on another topic. Okay. Now, but this zone is between this B and this 38.2. What we are telling you is that if you decide to place a trade, so it's not advisable to trade retracement. This movement from A to B is a rally. This movement from B to C is retracement, because it's not advisable to trade retracement, and because between the B and the 38.2, there are no much retracement zone in between. You have 90% chance that if you put a trade here, you will win, and 10% chance that you will lose. But if you are putting a trade here, you have to make sure that your take profit is standing here at the 38.2% level. Okay? Your take profit has to be at the 38.2 replacement level. If you don't have it there, there's a high chance that the market gets there and immediately it gets a candlestick formation and that market reverse. And you can be in a loss. Then the next zone is between 38.2 and 0. Okay? 38.2 and 0. So between 38.2 and 0 or 100, see, I have 1, 2, 3, 4, 5 levels. 38.2, 50, 61.8, 78.6, and 86. Now, what we have come to know, or what we have come to realize in this market over time, is that at these levels, because these levels, they are hidden level of support and resistance that you don't see with your naked eye. At this level, the market tends to give us candlestick formation. So the market can come to 38.2, it gets a candlestick formation, it moves. It gets to 61.8, it gets a candlestick formation, it moves. So because of that, you cannot tell if the candlestick formation is going to come at 38.2, or if it's going to come at 50, or if it's going to come at 61.8, or if it's going to come, you cannot tell. So because you cannot tell, it is advisable not to trade this zone. If you ever try to trade this zone, you have a 50-50 chance. 50% chance that you will win the trade, and 50% chance that you will lose the trade. Okay? Then the last zone is the 80-20 push zone. This is where you want to trade. This is what you want to see. When the market starts retracing to any of these levels, and then the market gives you a candlestick formation. Now, take this from me. A candlestick formation on a bigger time frame is a crown on a smaller time frame. I don't know if somebody catch that. If you see a candlestick formation on a daily chart, for instance, that candlestick formation on a 1 hour chart is a crown. Are you seeing this crown? Are you seeing this small crown? A, B, C, D. A, B, C, D. Are you seeing this small crown? This red small crown here. Can you see that? This small crown. Look at it. This is A, this is B, this is C, this is D. And then there's a here, there's a B here, there's a C, and there's a D here. This crown formation that you are seeing is telling you that the market has created a reversal. But if you are seeing, you will see this on a smaller time frame as compared to the time frame where you are seeing that candlestick formation. So you may see the candlestick formation on 4 hours, but on the 30 minutes, it's a crown. You can see the candlestick formation on weekly, but on daily, it's a crown. I don't know if you get me. So a candlestick formation on a higher time frame is actually a reversal. It's a reversal setup on a smaller time frame. Okay, so every time you want to aim at trading the 80-20 push zone. That is 80% of the time you will win your trade, and 20% of the time you will lose your trade. Which one do you want to go for? So this, you see this arrow that is pointing up and this arrow that is pointing down. If we must trade in the up direction, we want to be in this zone. If we must trade in the down direction, we want to be in this zone. Okay. All right. Having said that, let's jump back. Let's jump back to our presentation. Okay. Let's come back to our presentation. Now, we say determine the trading zones that the daily chart is in. So the trading zone is either the 80-20 push zone, 90-10 retracement zone, or the 50-50 no trade zone. So if you are able to determine that the market is on the 80-20 push zone, then you want to look at your stochastic if it's going in the same direction, or you want to switch to a 2-hour chart and start to look for trade in that daily push zone direction. So you can just be having counter trend line break on the 2-hour that are putting you in the trade, but your take profit is going to be coming from the daily push zone. Okay. Then number 3, you say figure out if you are entering the market on a retracement move or an extension move. Okay. Retracement or extension from the zone that the market is, you already know. If you are in retracement, it's going to be either on the 90-10 retracement zone or the 50-50 no trade zone. But if you are on the push zone or the extension move, then it will be on the 80-20 push zone. Every time you see extension is the 80-20 push zone. Then you need to make a projected decision about whether the market is on a trade, either the market is a trading day or a trending day. A trading day, a typical trading day, is a day where the market will move the allotted amount of pips. So every currency pair you see in the market, they have a designated amount of pips they will move in a day, every day. So maybe Euro USD can be 50 pips in a day. GBP USD can be 70 pips in a day. Okay, so before you enter the market, if you know that the market is meant to move 70 pips in a day, and you are looking at the market, it has already moved 65 pips. There's no point entering the market again. You already know that it's not going to, the market is not going to move anything else before the market shut down for that day. So there's no point taking the trade. But if you are entering, if you are looking at the market and you are seeing that out of the 70, it has only moved 25 or it has just moved 10. Now that gives you a guide whether you should enter the trade because there are potential pips to be made, or you should not enter if there are no pips to be made. So that's where you say make a projected decision whether you want to, whether it's a trading day or a trending day. Okay. If it's a trending day, a trending day is a day when you have fundamental announcements that have high impact. Okay. Fundamental announcements are predetermined news of macroeconomics data that are released on a weekly basis, on a daily basis, on a monthly basis, and on a yearly basis. So when you see every macroeconomic data, you are going to see 3 things in front, either day on day, or month on month, or year on year. Okay. Usually the ones that are year on year, they have more impact in the market than the ones that are month on month, or days or daily. Okay, so the ones that are month to month, some of them are, they are very aggressive and they have high impact in the market. So if it's a trending day, you want to stay away from the market until that news announcement or that fundamental announcement comes out, and then you see how well it's going to play the market. What happens is that on a trending day, the market is going to move 1.5 times its normal trading day. So if the market is supposed to move 100 pips in a day, okay, you are going to multiply 100 by 1.5. That will give you what the market will move on a trendy day. Okay. Then number 5, you need to ask yourself, is the market currently in the active zone or the market is entering into the dead zone? So every day, the market moves from the active zone to the dead zone every day. And now, you know, the market is traded commencing from the Eastern Standard Time, which is the United States time. Okay. But for us in Nigeria, because we are close to London, we tend to use the London time. And now the London time, sometimes you only have a difference of 1 hour, you know, at some point. But a lot of the time we have the same time frame. Okay. So when London is 8 o'clock, we will be 8 o'clock. But there are times when London is 8 o'clock and we are 7. Or there are times when London is 9 o'clock, we are 8. Okay. So now let's take a typical Nigeria case. If you wake up in the morning and you are working on an 8 to 5 job, you will take your bath, take your breakfast, take your bath and take your breakfast and do everything you want to do, and you go to the office 8 o'clock. And then by 5 o'clock, you are probably wrapping up whatever you are doing in the office and preparing to come back home. Now, because most of the activities that happen in the Forex market are things that happen in big banks, okay? Most of the biggest, okay, so for instance, the UK, the trading volume in the Forex market, UK alone accounts for 75% of all the total trading volume that happen every day. The Europe accounts for 75%. So now, when people wake up in Europe, 8 o'clock in the morning, they go to the office, and then by 5 o'clock they are closing. What happens? All the activities from 8 to 5 will make the market to be very, very active. But by 5, when they are closing all the offices in Europe, all the banks are shutting down, all the financial houses, they are closing, the markets, they are closing. At that time, nobody is posting transaction. If you walk into First Bank, people go to First Bank, make deposit, make withdrawal, all those withdrawal deposits that they are making, people are sitting down there that are posting the transaction. They go to the software, be it FlexQ, be it Finaco, that the bank is using, they will start posting transactions. As they are posting those transactions, the effect of those transactions are what you are feeling in the Forex market, right? Those are when you see the market, a candlestick will go up, candlestick will go down. This is what is causing that thing that you are seeing, right? Is those transactions they are posting. So by 5 o'clock when they are closing, all those postings are going to start dying down. Now by 5, when the office are completely closed, that frenzy that you are seeing in the market will no longer be there. So you say that the market enters into the dead zone. So we are using the UK time because the UK accounts for 75% of all trading volumes that happen in the market every day. So when all activities in UK and Europe are dying down, the entire speed of the market starts coming down. And then the market, the US session will now run the market until around 10 p.m. Nigeria time, and the Asia session will now come in. When the Asia session come in, you will now see activities of New Zealand, Australia, China, Japan. You start seeing the activities taking place in the market. So you see that maybe at night you are sleeping, only for you to wake up, USD JPY, there's one big candle. Why? Because the Japanese market is active at that time. The Australian market is active at that time. The New Zealand market is active at that time. But you are sleeping. Okay. So you can wake up to see big candles in those currency pairs. But those major pairs that that deals with US, UK, you see that the activities will drastically reduce. I don't know if it makes sense to you guys.
Yeah, it does. It makes
It
sense.
makes sense. So what's the best time to trade? Is it the UK time or the US time zone? If you are you're in Nigeria here, like we are, what's the best time zone to trade?
So for
And
Nigerians,
you are not a
for
late night person.
yeah, for Nigerians, the best time to trade is between the hour of 8, 9 a.m. to around 4 p.m. That's the best time. That's where the market is very, very active. Okay. So anything after that, the market start dying down. Okay. But now this is because this is for those that are doing intraday trading. If you are doing position trading or swing trading, where you are taking your trade from the 4-hour time frame and the daily time frame, you don't need to bother about active or not active, because after all, you're going to leave your trade for days. The trade is going to move from day 1 to day 2 to day 3 to day 4. So you may not really be bothered about whether the market is active today or it's not active today. Today, the market can be active today, and tomorrow you may not get that kind amount of movement you had the previous day. Volatility changes every day, okay, and economic activity changes every day. So for Nigerians, since we are lining up perfectly well with the UK, the best time to trade is our 8 a.m. to our 5 p.m. And inside that 8 a.m. to 5 p.m., I'm saying the best period is between 9 p.m. and 4 p.m. Okay? Because going into 5, the market has already started dying down. And going into 9, the market is just waking up. Okay, so you want to allow the market to completely wake up before you start, taking position. Because the market can try to want to start and give you an indication like it's going to buy. You rush into that buy only for the market to start fully and it's not selling. Okay, so that's why you need to wait to around 9, before you start engaging in trading activity. All right, so look at the projected daily trading range and estimate how many pips are potentially left before the market is the estimated daily trading range and enters the dead zone. So before the market enters the dead zone every day, the market will run that trading range that is ascribed, that is assigned to that market. There's a value that is assigned to every currency pair. And the last item, 7, it says review your checklist and make sure your trade meets the criteria of a 1 to 3 risk reward equity management ratio. That is, if you place that trade, your take profit should be such that it is 3 times your risk. If, let's say, you place the trade and you say, okay, if the trade does not favor you, you are willing to lose $20, then be sure that if the trade is going to favor you, you must make $60. Do you understand? That's what we mean by 1 to 3 risk reward ratio. So we talked about number 1, just to expand them further. Number 1, we said determine the monthly, weekly, and they are lining up. Okay. I already explained it, so I don't need to go through this talking point. It's just to help you understand that, okay, for you to enter the trade, you want to see that monthly, weekly, daily are trading in a compatible trading zone. So this is what we're talking about. So the market can be moving from C to D on the different time frame. So this is your monthly chart, your weekly chart, your daily chart, and then your 4-hour chart. So this is your monthly. See the zone where the market is your down retracement zone. Your weekly is showing down retracement zone. Your daily is showing down retracement zone. Now, if all these are showing the market is in the down retracement zone, then what do you want to do? You want to come to a 2-hour. 2-hour. First, let me understand if you will get the point, down retracement zone. Okay. If I go back to the one I used to explain earlier, right? If I come back here, when you sit down, are you seeing this is A, B, C, D to the downside. So this is our down retracement zone, right? Down retracement zone means that the market is what? The market is going up. Can you see that? Our up retracement zone means that the market is going down. Okay, just to put clarity to that. So when I say all of them, they are on the down retracement zone, I want you to understand that it means that the market is going up. So what do? You come to your 1 hour time frame, look for a beautiful trend line break, and start to buy the market. So you are now buying the upward zone. You are buying the upward zone, which is lining up with the down retracement zone of all these bigger time frame. That's what is happening here. And that's why this market can move this much. Okay? Because this one is on a down retracement mode, means that it's buying. This one is on a down retracement mode, means that it's buying. This one is on a down retracement mode, means that it's buying. So you look for trend line break and buy on the smaller time frame. Okay.
So you mentioned 1 hour. What is it? Can you do 2 hours? One or 2 hours?
You can do 2 hours like this one. This one is 2 hours, right? You can do 2 hours, you can do 1 hour, you can do 3 hours, you can do 4 hours. In as much as this time frame is smaller than these 3 time frames, you can trade from anything below any time frame that is below this 3 time frame. You can trade from it. These 3 are your guide, okay? Why this one is your trigger or your entry. So these ones are more like your trend time frame. And if you look at the stochastic, look at this place, this stochastic. You see the stochastic here tells you that the market is going up. See the stochastic here tells you that the market is going up. See the stochastic here tells you that the market is going up. All these 3 stochastic are pointing in the up direction. Then you come to the smaller time frame and you look for, in fact, in this case, you can look for where the stochastic shows that the market is going down and then put a trend line as its market is breaking that trend line. Look at the stochastic. You see that it's exiting from the sell zone. Sorry, and your market is lining up with your bigger time frame. Okay. So point number 2, we said determine what trading zone the daily chart in. So now here we have said 1, 2, 3 lineup. Now we said we have narrowed it to only the daily. Which zone is the daily? So if all of them are in the same zone, where is the daily? Daily is actually also on the down retracement zone, and then we say we can buy from here. So if you know where the daily is and what the stochastic is doing, you can use that as a reason to jump to your smaller time frame and start looking for trade in that direction. So let's just read this talking point. Say, by understanding where the market is on a larger time frame will help you to decide the possible or probable success of the trade. You will have greater success trading bearish in the down push zone or the up retracement zone with the stochastic moving in the same direction, trading bullish in the up push zone or the down retracement zone with the stochastic moving in the same direction. So you just come to the smaller time frame, knowing fully well that the bigger time frame has told you the direction the market is going to go. Then you start applying these our conditions. Okay, don't worry. In the forthcoming slide, you're going to see some of the conditions that you apply to take the trade. So we talked about, already explained this zone. I say we have the 90-10 retracement zone, the 50-50 no trade zone, and the 80-20 push zone. Okay. So these are the zones. If you explode the chart, you see we break it. So this is the up zone, right? And this is our A to B. Now it's okay. Yeah, we have gone A to B, A to B, A to B, right? So, but now my 90-10 up retracement zone is my B to 38.2 level. My 50-50 no trade zone is my 38.2 level to the 100 level, okay, ground level. Then my 80-20 push zone is anywhere. It can be here, it can be here, it can be here, it can be here, it can be here. And on the smaller time frame, I need to see a crown on the smaller time frame that say A, B, C, D down, A, B, C, D up for me to start buying the up push zone. Okay. So this is the exploded diagram of those 3 zones. Now you can also see for the down. This is the exploded diagram for the down. So all three A, B, A, B, A, B, the first retracement zone is 90.10, is from the B to 38.2 level. The second retracement zone is from 38.2 retracement level to the 100 retracement level. And then your push zone is your C, which is your reversal on the smaller time frame that will lead you. You are going to have left tip, center tip, right tip, then the market will start running down. Okay, so these are the three zones that exist in the down ABCD price range. Okay, so we already explained this before. All right, so now looking at the market in itself, these are the zones. Okay, so now you want to trade this zone. You want to trade this zone. So if you are trading this zone, we are saying you are going to look for A, B, C, D, A, B, C, D, and you are going to be trading the C to D. So yeah, I'm going to, because this is upward zone, I want to trade C to D, C to D, C to D, C to D, all the C to D, I want to trade all of them. So a quick way for me to trade the C to D, a quick way for me to trade the C to D would be for me to put a trend line break, put a trend line, a counter trend line break here, counter trend line, counter trend line, counter trend line, counter trend line. As the market is breaking the counter trend line, is going in this C to D direction. So for this C to D, this is the daily, and this is the 1 hour or 2 hours. It means that I can have C to D1, C to D2, C to D3, C to D4, so I can have 5 different trades and make profit 5 times just in one C to D movement on the daily time frame. Okay, and you need to ensure that your stochastic, while your market is turning from point C and start going to D, your stochastic is also coming from this zone. Okay, so the same thing is applicable to the down push zone. So you can trade now. So one formula you can use to trade the push zone is applying the 1 2 3 candlestick formation. Okay, you can apply the 1 2 3 candlestick formation. So if you apply the 1 2 3 candlestick formation, you can start, or the 1 2 3 trading strategy, you can start selling or buying, in respect to that zone that we're talking about. You can start buying just one zone. You can stay in one zone for a long time, trading and making profits. So this is what I'm talking about. We've talked about this before, the 1 2 3 buy, and then we also have the 1 2 3 sell. Now, what is 1 2 3 buy? 1 2 3 buy is when the market creates a bullish candlestick formation, the market breaks an aggressive inner uptrend line or a counter trend line, and then the stochastic is leaving the buy zone. So if we have these 3 conditions on your chart, and I'm telling you that this condition, you can see it right here. You understand? When the market gets to this C, look for this condition. Anytime the market pulls back to this C, you start looking for the condition. So the market pull back to this C, you look for that condition, it goes. It pulls back again, look for that condition, it goes. It pulls back again, look for that condition, it goes. Just like that. You can keep buying the ABC, continuously in an uptrend. So what if the market is a counter trend line? Then the market gives you a morning star formation, okay, and then you say the market on stochastic is leaving the buy zone, so you can put a buy trade. Okay, that buy trade is what has run all the way to the up here for you. Okay, then 1 2 3 sell is the opposite of 1 2 3 buy. Okay, so you put a counter trend line, the market breaks the counter trend line, and then it gives us a bearish engulfing candlestick. Here it gives us a bearish. So this candlestick formation here is a what do you call it? It's a doji star, right? So this is a doji star. So the market gives you this formation and then breaks this aggressive trend line and then the stochastic is leaving the sell zone, then your market will go very well in your favor. Even after the market created this, look at the market created what? A bearish engulfing candle here. Okay. And all this will make the market to push very well to the downside.
So how do you know? Sorry to take you back.
Yeah.
How do you know the market is going to go down from the stochastic? Is there a leading indicator on the stochastic that tells you?
The
Because
stochastic, the stochastic is the stochastic is a leading indicator.
okay.
Yeah.
Because
It's a leading
the
indicator.
entire stochastic will not be formed for you to be. Will it be formed for you to be able to take a decision based on that?
So let me switch to a chart. Okay. So let's say this is a chart, right? So let's see some. Let's do. And then we'll come to oscillator. So let's take stochastic. So just take stochastic and apply. So if you just apply to stochastic, this is the default setting of stochastic, right? Okay, so with this default setting, look at it. Look at this stochastic. When the stochastic is this zone, when the stochastic is here, we say the stochastic is overbought. When the stochastic is here, we say the stochastic is oversold, right? Then now look at this market here. Just take this for instance. This market came down. All this coming down, like you're seeing here, is all this movement like this all the way down, right? Now, at this point, even though you are seeing that at this point on the chart, you are seeing that, oh, it looks like this place is higher than this place. So look at this place. It looks like this place, in terms of the candle body, is this one here. This candle body here is higher. I can decide to do something. Say, let me remove the properties. I want to, so that, but though it will not be very clear. Okay, no need, because if I will not be seeing the black candle. I wanted to remove the wick so that you can see the true body, okay, as the low and the high. So, but now, what you are seeing here, even though this stochastic, this body of this candle did not come below this one, you can see that the stochastic is already in oversold region. So what you are looking for here is a candlestick formation. You want to see that now that the stochastic has entered this oversold region, you are looking for a candlestick formation in this region.
Yeah.
Do you understand? So in this case, in this very one, I can take 1, 2, 3 candlestick as a candlestick formation that is called 3 advancing soldiers, right? 3 advancing soldiers. So I can just come here. After the close of this one, I put a buy here. Buy the market from here. Okay. You see that? And then this will not go in your favor. Now, another person may say, no, I don't want to wait until the market gives me 3 advancing soldiers. I want to enter the market on the first candlestick in the oversold region that breaks above the previous bearish candle. So look at all this bearish candle here. This is a bearish candle. This bullish did not break this one. Bearish, bearish, bearish. This bullish did not break this one. Bearish, bearish. This bullish did not break. But this bullish break this bearish. Are you seeing it?
Yeah.
Now, at this point where the bullish break above the bearish, you can say that the bulls are taking power from the bears. Can you see that? Now, at this point, so that this one break this bearish, you can come here and say at the close of this candle, take a buy. And market will go in your favor. Or another option is you can come here and say, put a line, put a counter trend line. So you draw a counter trend line like this, it touches the wick, You pick it from where it touches the wick, you draw the next one. All right, so we stop here. The candle that breaks the counter trend line, I've explained it before, okay? If the candle that breaks the counter trend line is not a candlestick pattern, let's say it's not a bullish engulf, it's not a bearish engulf, it's not a morning star, it's not a evening star, it's not a dark cloud, it's not a piercing line, it's not a shooting star, it's not an arc, it's not an angry man. If it's none of these, if it's just a candle like this, we want to see minimum of this candle above this line should be 70%. 70% of that candle should be above the line. If 70% of this candle is above the line, then at the close of that candle, put a buy. And put stop loss below this wick here. And this market will go in your favor.
Okay. Sounds good.
Is it clear?
Thanks. Yeah.
All right. Okay. So this is my 1, 2, 3 buying strategy and selling strategy. You can apply it to any chart, any time frame, and any market formation. So in this case, we are seeing a consolidation. This is a consolidation. The market came here, got here, went back to almost the same area I came from, came back to the same region, went back to similar region, came back to the same region. So you say this market is what? This market is ranging. But this market is ranging on a weekly chart, is ranging on a daily chart. Then you want to go to 2-hour chart and start buying or selling this range. This is the best time you will need stochastic. This is the best time. Stochastic is most effective in a ranging market. So a consolidation, when the market is consolidating, we say the market is highly predictable. So I know that when the market gets to this point, the market will kind of give me these 3 conditions: create a bearish candlestick formation, break an aggressive trend line. Stochastic is moving from the sell zone. These are the 3 things I want to see. And when I enter the trade here, I will not do anything. I will come and set my take profit here at the bottom of this consolidation. If this is weekly, from year to year can be more than a year. From year to year can be more than 6 months. From year to year can be more than 3 months. So you can take your trade here and patiently wait until your trade comes to this level to take your profit. But if you don't want to be in a drawdown, you can say, okay, I want to be taking all the counter trend line breaks. So here you draw a counter trend line, here you draw a counter trend line, here you draw a counter trend line, here you draw a counter trend line. So you can even be in 1, 2, 3, 4 trades before the market hits the potential take profit region, which is the base of the consolidation. The upper zone of the consolidation and the base of the consolidation are your take profit and your stop loss region. So if you sell from here, your stop loss will be above the upper zone. Then if you buy from here, your stop loss will be below the upper zone. So once you buy from the lower zone, your take profit is the upper zone. If you sell from the upper zone, your take profit is the lower zone. And your stochastic can neatly guide you in doing this. Okay? So we can do this on a big consolidation. So this is an example of a big consolidation where the market met all these conditions: 1, 2, 3 sell, break aggressive trend line, market candlestick formation, stochastic leaving what? The sell zone. Take this trade, wait until this trade get to this level, watch out for these 3 conditions, take this trade, wait until you get to this level, watch out for these 3 conditions again, take this trade until it gets to this level. You keep going up and down. But now look at where the market break out from the consolidation. Did you see that there is no candlestick formation here? Here you have a candlestick formation, here you have a candlestick formation, here you have a candlestick formation. All the others you have candlestick formation, but here where the market is going to come out of the consolidation, there is no candlestick formation. Rather, the market break that consolidation with a strong momentum candle. This is a strong momentum candle. Okay. And then the market fall down. So this is what you want to do. You want to go to, so let me go back to that chart. You want to come to this chart like this and say, okay, let's go to weekly time frame. So we go to time frame, say weekly. Okay, let's see where the market is ranging. We see where the market is ranging. We can easily tell, okay, where we are going to take this trade from. So weekly. Okay, so let's compress it a little bit. Ding, 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 ding. Oh. Okay, so I'm not seeing a very good at this here. Let's look for another chart. Let's say GBP USD. Okay, GBP USD. GBP USD has been trending, so there's no consolidation here. Euro USD the same thing. USD share the same thing. Okay, so let's look at this USD CSF now. Let's look at this USD CSF. So this market, watch this. I want you to watch this critically. This could be an opportunity for you to already have a trade that you want to trade. Look at this market. This market formed this high, and this market moved from this high to this low. Okay. And then this market moved from this low and came all the way to this high. Are you seeing it? This high. Now, if the market is going to pass, the market will just blow past it, right? But now, the market did not blow past it. Instead, the market creates a candlestick formation here for us. Okay? Create a candlestick formation here. So what we are looking for, the three things we are looking for is one, the market breaks this trend line, right? This is our first condition. Market breaks the trend line. Condition number two, the market form a candlestick formation. So here I have a bearish engulfing candlestick. Condition number three, the market is leaving this area. It's leaving here. It's leaving the sell zone. So with these three conditions here, okay, I've said that this market is when the market came down here, it breaks this low. So it's not consolidating, right? But now the market did not break this high. So I can say the market is now consolidating from here. Okay, so it's on the market to break this high. The market did not break it. Look at it, tried it, went first time, second time, third time, fourth time. If I did it the fifth time, after the fifth time, it still did not break it. Instead, after the fifth time, what happened? It gave us a bearish engulfing candle. And then when we drew the trend line, let me make this trend line big. Okay, tick. And we drew the trend line, can we shoot the ray out? So let's see. Ray to the right, ray to the left. All right, so you see that. So you see the market breaks the trend line. After several attempts to try to break this place, it couldn't break the trend line. Stochastic is leaving the sell zone. Okay, and then we have the candlestick formation. So the three conditions are met. 1, 2, 3, sell. Then you put a sell right here. Yeah, Prince, go ahead.
Yeah, okay. So I want to clear something that has been bothering me. Like the way you drew this the resistance line now, both on the body and on the wick. So I want to
Yes.
know whenever say a resistance or a support line has been broken, is it when the body closes above the wick of the maybe of the previous test? That's when you say that resistance has been broken, or say we just have a wick that goes above and it comes back again and close below the previous wick. So I want to really know, because sometimes it get me confused.
Okay.
If our wick the close of the body or just the wick.
Okay. In one of my classes, I don't know if you're in that class, I did say that there are two ways to draw. There are two things you consider when you are drawing support and resistance. One is the body, one is the wick. But I mentioned something about the wick. I said the wick can be manipulated by the broker. Do you understand? This wick you are seeing here now on this broker, if you go to another broker, it's not going to be at the same price level. The another broker own may be longer. Another broker may be shorter. So if you want to use wick as true representation, you will be making a big mistake. The most accurate of the wick and the body is the body. Now, that doesn't mean that you throw the wick away, because it's the wick that will tell you that, hey, this market got to this point before it made this, sudden change that it made. It's the wick that will tell you, okay? But I don't rely on the wick when I'm doing my support and resistance. I don't rely on the wick. I prefer the body. Like, look at this place now we're talking about. You can see that nobody here, none of the body here breaks above this body. Look at it. Look at this line. Look at the body. Let me take it up a little bit so that you can see it. None of this body here breaks above this level. Imagine this strong momentum candle like this. Came just very close to the body and it stopped. It couldn't break. His brother tried, couldn't. The next one tried, couldn't. He formed a bearish candle down. After forming the bearish candle down, he attempted to go back to see if he can break it. A second time, he still could not break it. In fact, what he successfully did was to create a counter trend here for us. Okay? A small double top. He did a double top that tells you, oh, this market is going to sell. Okay? And then what happened? The market fell down with a candlestick formation. So you can start selling from that candlestick formation. That's why you see that this market is selling until this time. Okay? So I prefer you do the body. Now, when you do the body, I'll give you another example. Look at this place here. Look at this place here. This is the body. This body breaks it, right? This body breaks it. But after this body breaks it, it came back immediately. If this market was going, if as this market break, this market was going to buy, what this market would have done, this bearish candle would have been the test for you to buy the market. But then the next candle was a bearish candle. So that violated this break. So this break is false break. It's called fake out. I'm sure you know fake out. This is a fake out. So somebody would have said, oh, this market is buying, and jump into the market to buy. And immediately the next person entered the market started selling. This is where most traders will say the broker is waiting for them. Okay? Because of a true, this place is a resistance. Two candles to the left, two candles to the right, make this place a resistance. And this place is supposed to be a higher resistance as compared to this. But then this resistance did not hold. So this market fell back down. Okay. And then this market came back the same way this market, break through this one and fake out. This one wanted to do the same thing, but unfortunately, this succeeded. And that's why the market is selling right now. I don't know if that makes sense.
It does. Thank you. It does.
Okay. All right. So I mean, if you're able to look at the market like this, so let me zoom it down a little bit. Okay. So this one even make more sense because the market is actually on a downtrend already for us. Okay. And then the market, in an attempt for the market to want to change the direction of this trend, it created for us a counter trend. Anytime you have a market come from resistance and return to that resistance, but then the body of the candle could not close above the body of the previous resistance, what you do, you say the market has formed a counter trend. When the market, when it hits here, when it hits this body and pulls back, you say the market has formed a counter trend. So when the market finishes forming the counter trend, what do? You go to the lowest point before the market formed the counter trend, and then you draw a trend line, pull it out, move it into the chart until it touches the first wick, and then you stop right there. So you see the market breaks that counter trend. It breaks that trend line with a bearish candlestick formation. If you want to be very, very accurate, and you don't want to have any drawdown, what you will do, you will look at this, your bearish candlestick formation, or any of these candlesticks that are the highest in this place that attempt to break this line and could not break their line. Draw a line behind them, draw a line behind this place, and let the market break that line and come back to test it. This is where you will sell. This is where your entry should be here. Your entry should be this value. You enter on this value, put your stop loss above the high, and then allow this market to run in your favor. Okay, so maybe this market will fall down all the way to this place, and probably, because sometimes this is how the market enter into a range. When the market did this, okay, came down and pulled back. Usually, if the market is just going to continue the trend, it's not going to pull back all the way to this. It's going to pull back to maybe anything from 86, 78.6, 76, 78.6, 61.8. But now it pulls back as if it wants to change direction. But unfortunately, it couldn't. Okay? And because it couldn't change that direction, then the market start to sell. Okay?
So what if you waiting for it to break that line and then come back and test it before coming down? What if it doesn't go back and test it, it just keep going down?
Yeah, so that's where you have aggressive and conservative traders. So we have two types of trader or two types of entry. Your entry could be aggressive in the sense that you just enter from this bearish candlestick that it breaks, okay? Or you wait to do the conservative one. Now, it's just like, it's not every trade in the market that you will take, right? If you have set a rule and said that you want to be the conservative type, just respect the rule. If the market doesn't come back there, no problem. Look at this market that run up here. Look at this place. This market run up to this place, right? This is the high. But where is the last low before the market run up? This low. Okay. Can you see how the market break this low, came back to this low here, and then fell down? You see that? These are some of the things you want to look for in the market. It's not just to, you can sit down in your house for 1 month, you will not trade. Okay? Why? Because you want a particular setup before you enter the trade. You want that setup to be met 100% before you take the trade. When you now see that setup, and that setup is now met, then you enter the trade. Nobody will understand why, as soon as you take the trade, the profit is very sweet. Okay, the person did not know that you have waited for 1 month.
Mm-hmm.
Do you understand? So
Yeah.
those are some of the things. So in fact, professional traders wait for the setup. It's amateur trader that jump into the market anyhow and start struggling to come out. If you are a real professional trader, you will wait for the market to create that setup that you are looking for before you take the trade. There's something we call let me see if I can show it to you. I just put the slide together, so I've not completely finalized the slides. Okay. But there's something we call score a point system. Okay. I just want to show it to you. It's not what we're doing today, but I intend to do it for you guys as a wrapper. We've done it before, okay, but just to put more explanation to it. So when you say market score a point and pull back, let me make it full screen so that you can see it well. When you say market score a point and pull back, this is what we're talking about. The market is making downtrend A, B, C, D, A, B, C, D, like that, okay? And now, this is what will happen. When the market is making this A, B, C, D, look at this line. Your work, the market, you are here, okay? You are here in this market now. The market is going down. It's going down. It's going down. But every time the market goes down, you need to draw a line across the eye. So all this eye now, they're now past resistance, past resistance, past resistance. So when the market hits here and come down, this place become a resistance. When the market move away from this place, this is a resistance. This is a resistance. This is a resistance. Now, if this market want to start going back to the up direction, what the market will do is that the market will first of all break the trend line. Okay? When the market breaks the trend line, it's not just breaking the trend line. It will not just break it will not just break, it will break the trend line, okay? And then it will break this resistance. I don't know if you guys are seeing this very clearly. It will break the trend line. After breaking the trend line, it will break this resistance. Whenever it breaks this resistance, the next thing you want to do, don't think of anything. Just look at the last low before it breaks this resistance. Where is the last low? This place. Watch this low. The market is going to possibly come and test this low. This low that's here. Market will come and test. When the market tests this low and this low is holding, from here, this market will start rallying up. So when the market start rallying up, we call it score a point and pull back. Score a point, pull back. What is score a point? Anytime the market breaks any of this past resistance, we say the market has scored a point. When the market has scored that point, the next thing the market will do is to pull back. After the pull back, it gives you a candlestick formation. After that candlestick formation, it moves to the next resistance. It moves to the next one. Where the next one? This one. It will break it, pull back, get candlestick formation, go up again, break this, pull back, get candlestick formation, go back again. This is what the market will do continuously until it will change direction again. So you as a trader, this is what you are watching out for. This is what you want to see. If you see, sometimes people will say the market is hard to trade. I've said it plenty times that it's the easiest thing to do in this world. But every time I say it, some people will laugh. They say, "Oh, because you understand it." It's not true. It's not true. This thing that we're talking, this thing I'm not telling you about now. If you look at this place, that was what was about to happen. But that pullback did not hold. This one could not score the point. Look at it. In this case, this is a resistance. This is a resistance. This is a resistance. Are you seeing it? But now, because this market has broken above this and it didn't hold, so this becomes the new resistance. For this market to buy, you need to first of all come and break this resistance, then pull back. Break this one, then pull back. Break this one, then pull back. If it doesn't do it, nothing. Even if we go to the past, now let's go to the past. Let's go to where it's coming from. Okay. So this is the first support here. Break the support, pull back. When this one has succeeded, it will go to the next support. So we have the next support. We have these are minor. So we'll take here that is major. Okay. So here is major. Breaks this support, pull back. Look at it. Do you understand? So we'll just be looking at all the key support level. When the market breaks them, the market will pull back. Okay, when it break it, it will break the support, pull back. Maybe this win is second. Look at it.
So
When it
what are
breaks,
you supposed to do when you
see
see
what
all this happening?
look at what you're supposed to do. What you're supposed to do is very simple. It's just staring at you in the eye. Let's take the first one. Let's take the first one. When the market breaks the first support and pull back, in one of my lecture, I'm sure it was the last lecture or the one before the last, I said, if the market is pulling back and you see that the market has formed three bullish candle, I said, draw a trend line. That's what I said. The market breaks here. It came down, and then started pulling back. As soon as the market started pulling back, once it has made three bullish candle, draw a trend line. The break of that trend line is your sell. The market breaks this level, it pulls back, draw, you see 1, 2, 3 bullish candle, draw an aggressive trend line on them. The market breaks this one, you see 1, 2, 3 bullish candle, draw an aggressive trend line on them. The break of those trend line is your sell. Break this one, sell. Break this one, sell. Break this one, sell.
Yeah, makes sense.
So you can imagine somebody came up with this idea. And trust me, that guy, I know him, is the master of this market. And is the founder of Market Trader Institute. He's the one that came up with this idea. You need to listen to this guy speak. If you listen to him speak once, I'm sure it will change your entire orientation. He's the one that developed this thing. So I've taken my time in the last few years to understudy what let me show you something. See this course. Let me show you this course. MTR. MTR. All right. So look at this course, the Ultimate Traders Package. Now, let me open the course. I'm almost done with it. Now, I've done this course before. Presently, you can see I've completed 83% of the course. I finished all the training.
I
finished everything about the training. Okay, I just have only this one module to finish to listen to. And by the time I listen to this module, then I will take the final exam. And when I pass the final exam, they will issue me a certificate. I've done it before. They've issued me a certificate before, but they did some update to the course and they make it available for us to do again. So I'm doing it. This is second time I'm doing this course. Okay. Let me see. Here's my LinkedIn. So if you go to my LinkedIn page, I think the certificate is there. Let's see. All right. So look at it. Yeah. That's the certificate. 2018. Okay. This certificate is for this course. Now, if I finish it again, if I do this exam again, they will issue me another certificate. Okay. Let me allow you to listen to the guy for 5 minutes. 5 minutes, then And I'll use myself. Just listen to him.
In your life, I mean, think about it. How Welcome back, everybody. This is the FX Chief. I'm excited about this lesson 6 because it's all about how important it is to alter your attitude, because when you alter your attitude, you can end up altering your trading results. As a matter of fact, do you realize that when you alter your attitude, you end up altering your life? I mean, think about it. How many people, seriously, that have a negative attitude that you love being around? Now, how many people that have a positive, uplifting attitude that you just love being around? Did you realize that you are the sum average of the 5 people you hang around? And as a matter of fact, you realize that whoever you hang around, 33% of those people are above your level, 33% are at your level, and 33% are below your level. This 33% that are below your level, you know what their whole focus is? Is to drag you down. And you know the 33% that are above your level, you know what their focus is? Their focus is to pull you up. And so the real question is, what are you doing hanging around this 33%? Because if you're the sum average of the top 5 people you hang around, wouldn't you like to get rid of this 33% and turn it into where 66% of the people you hang around are above your level and the 33% are at your level? You have a greater hope of achieving success. You know, when you hang around 5 negative people for 5 years, on the 6th year, you'll be the 6th negative person. But if you hang around 5 positive millionaires for 5 years, there's a high percentage chance that on the 6th year, you'll probably be a millionaire yourself. Or one of the greatest discoveries of my trading career is that a trader can alter his trading results by altering their attitude. I said you could alter your life by altering your attitude. Think about it. And you could alter your trading results by altering your attitude. So much of life is attitude, and it's not negative attitude. I'll tell you what, when I see negativity of any style, when I am around people that love to gossip, love to complain, love to whine about how horrible their life is, man, I run as if there was a plague in town, because I don't want anything to do with it. I need all the positive energy that I can get into my life. Do you realize that 97% of all people die flat broke because they stopped dreaming somewhere along the way? As a matter of fact, they took on an attitude that life beat them down, that life won, that life conquered them, and they no longer have dreams. How sad that 97% of all people, and we talked about this in a previous lesson, end up retiring and going to their death in a state of poverty with no dignity. Did it ever occur to you? I mean, you know what? The older people get, the more stubborn and grumpy they get. This is the reason why. Because, you know, during the course of their lives, they had problems, and we talked about adversity, and we talked about problems in our lives. They had problems that conquered them instead of them conquering their problems. They had problems that turned them into victims instead of becoming victors. They had problems and challenges in their life that instead of winning above and beyond those problems, they turned into whiners. And so now you got all these old, grumpy, miserable people walking around in life, you know, not happy. And what slowly happens in their life? Boom, boom, boom. Things in their life just don't go their way. Relationships go down. You know, friendships are lost. You know, income disappears. So they end up working where? At a grocery store, perhaps as a greeter in Walmart. You can change all that by altering your attitude from a state of negativity. Now, if you're listening to me and you're challenged with being more negative on a daily basis than you are positive, then take responsibility for your destiny and your future. Alter your attitude from negativity to positivity, because more amazing things will come into your life when you think positive. Now, successful trading on the Forex is not a fantasy, it's a formula. And a critical ingredient to that formula is a positive attitude. A positive attitude is the high performance fuel that keeps the engine running.
Raju, tell me, do you like that?
Yeah, that was powerful. It's a good one.
Amazing,
So,
amazing.
Amazing.
so this guy is extraordinary. You see, of every course, if I start pulling, so you see this place, say FSship mentorship, right? The title of this one is Alter Your Attitude. If I go to another one, you will see another mentorship there. No, this one does not have. Let's see this one. You see this one? Greed and fear. Talks about greed and fear. Let me give you a snippet of that one. Sometimes it's not just about candlestick, right? Sometimes you need to hear this message,
Yeah.
in order for you to fully appreciate what you are doing. Let me see, something is wrong with this one. It's not loading.
Welcome back, traders. This is FX Chief. We are on lesson 5 on greed and fear control the markets. Now, it's very interesting you understand the truth about this and how important it is for you not to let greed and fear control you. It does control the majority of loser traders, but master traders do not let greed or fear control them when it's time to trade, because they focus in on their technical skills and managing their emotions, and their reward is capturing pips, which in turn allows them to capture money. Let's start off by talking about greed. Okay. Greed has only one objective, and that is to wrongfully take, consume, and ultimately destroy everything it touches and around it. It has no feeling or pity for the devastating consequences or the destruction it places on people or even loved ones it knows. It is ruthlessly ready without any notice to destroy everything that is beautiful in your life. It does not care who or what you are, and it is not capricious. It doesn't hesitate to crush the life out of any human being that gets in its way. It takes what it wants from everyone and anything, regardless of any consequence. It moves as if it is above the law. Greed has no time limit to its ultimate destruction. When its hungry appetite surfaces and awakens inside you, it will lie to your soul and promise you the world. It believes that money and money alone is life's answer. It stops at nothing until it's temporarily satisfied. But don't be fooled that it is ever satisfied, because it's not. It is always ready and quick to set its sights on something new, enabling it to replenish its appetite. It is more addictive than a drug. And like a drug, it's constantly looking for a new high, something more to acquire at whatever cost. Do not fail to recognize it in your life. If you are not one of the unlucky ones possessed by it, get rid of it, and get rid of it now, as you will ultimately suffer. If you are currently in its way, run. Get as far away from it as you possibly can, and at any cost, or you will become its next victim. Its name is not pleasure, its name is greed.
Perfect definition or Greek?
That's a good one.
See that? So you know, when you hear this kind of things, okay, then you come back to the chart and you do
Yeah.
all you see everything you see here, you can see that everything is marked good, right?
Hmm.
I've done them a second time. I've done them before. I've done them a second time with some little advancement to them. And then anytime I feel I'm going to come and take this exam. By the time I do, this one is not checked because I've not finished this video. By the time I finish this video, this one will be checked 100%. And then I enter the, and then I
Running. Now,
enter the final exam. And once I
Yeah.
finish the final exam, it's about 120, 124 questions. Okay.
Yeah.
And you have to pass it. Okay. So it's important that you are able to, because you need a boost, okay, to your trading career. So you have to be
Yeah.
able to do things like this, and understand it. Once you understand it, you see what I'm explaining? It's simple, right? It's simple. And even if you look at what I just explained, you will like in this place now look at your stochastic. Remember, this stochastic is the default value. You can change it. You can right click on this thing, select stochastic properties, and change it. If I change, I can smoothen this thing from 3 to 7. If I make it 7, it makes my entry smoother but slower. Do you understand? It makes my entry smoother but slower. Now, look at this stochastic here. This whole cell that you see that came down here started from here. This is actually the beginning. This was where the market was overbought. Okay. Even though this market rally up here, what this market has done here in trading context is called divergence. Okay. Divergence. I'll draw it for you. So you look at this high. Look at it. This eye is lower than this eye, right? The wick. Even if you go by the body, you see a little difference. This one is still higher. Okay. Then now look at the stochastic. This high is lower than this one. This one is higher than this one. So this low here is this high here. Why this high here is this low here? It tells you that something is about to happen. There's a trick. Something is going on in the market. Something is about to happen. The indicator is doing something different from what the candlesticks are doing. The candlestick is telling you that the market is creating a higher high, but the indicator tells you that the market creates a lower high, telling you that this market is going to sell in no time from now. Get ready to sell. Now, when you can actually take this sell all the way from the up here. That's a good thing about divergence. Divergence will put you in the market very early. If I see this thing on the market, I'm not going to wait for this candlestick to form. This candlestick will be part of my profits. I will sell from here. Okay. And when I sell from here, I start looking at every of this line crossing. Every of this line crossing become my pullback, continue, all these ones. You understand? So when the market gets to this bottom, do nothing, wait. The market pulls back. Okay. It gives you candlestick, because now it's not reaching the very top. So some people can be so conservative and say, if the market did not get to overbought, I will not take the trade. So, but for the fact that you have entered the trade here, this trade is running. The market hit here, it didn't get oversold here, but then eventually it came overbought again here. For this second overbought is lower than this overbought here, this one. So it tells you that the market will still go down the more. All you need to do, put this your counter trend line, wait for the market to break it and possibly pull back and then hit the sell, okay, to continue. Now, the same thing happened here. And watch it, the market pulls back here, couldn't break this. And then the market says sell again. You draw another counter trend line here again, okay, right here. And you are still in the sell. Okay, so this market is still selling. This market must go, before this market will change direction, this market will go down. Now, as this market goes down, it may even go lower than this one. Okay. Meanwhile, the market will not get to this low. If this market comes here and it did not get to this low, somewhere here, and it's giving me a U-turn, why this one has gotten below this low and even gone below this, that time I'm going to be having divergence like this to the downside, and then divergence like this to the upside. Okay, this is another divergence telling you that the market is going to change direction. At that time, all you need to do, you put your counter trend line and wait for the break of that counter trend line after the divergence, and then you enter the market with your buy. That time, all this your sell, you would have closed them, and then you take a buy. So this is how you want to enter the market. Okay. And this you can do on daily chart, you can do on 4 hour, you can do it on any chart, basically. You can decide to change this your stochastic. I can decide to change this my stochastic to 53.7. So if I say 53.7, it will be like a trend line. Are you seeing it? So this is still my divergence. This is my high of the stochastic. This is the low of the stochastic. And this is the high of the candle and the low of the candle. So the market still diverges. After the divergence, the market keeps selling, selling, selling. Can you see this next one now that it pulls back? This divergence here, this oversold here, this overbought here. You can see it here. All these other ones that were deceptive before, they all become like a straight move all the way down. You understand? And even if you look at this buy, that this market buy up, you will see divergence. They look at it. This low to this low. Okay, look at it on the stochastic. Is from low to high. Look at it. So this is a divergence that made this market to do this pullback. Unfortunately, could not break. It pulled back, could not break this high, and then the market gives you a second candlestick. And of course, this is overbought, and the market is actually selling. So all this you need, and you need to know. I have a lot of stochastic values in my head that I use, and I know the way all of them behave. I know how 100 behave, I know how 50 behave, I know how 70 behave, I know how 60 behave. This thing is by training. You do it continuously. If you practice this over time, you become used to it. Okay, and you can start applying it to your trade. I set up something the other time in one of our classes where I said, okay, let's create a trading pattern. So we created something. Let me just open it right here. Created a template and we called it ZipatFX trading system. Yeah. So apply. Look at it. Now when you apply it to the chart, you see how it tells you, see these three lines or these 4 lines. Can you see that even when the market pulls back like this, these 4 lines, none of them crosses each other. Look at it, they did not cross each other. Because they did not cross each other, it means the market will still go down. That's what it means. Because this blue, look at it, even here where they try to cross, this blue did not effectively cross the white. So it tells you the market will still go down. Anytime you have the market pull back, if the moving average does not cross each other, that market is still effective in that direction. So the change actually comes when the moving average cross. You know, look a good example. You look at it, this market came down.
So the moving average. Sorry, the moving average, which values are you looking at for the moving average?
So for this one that we have here, I have this one is
21,
21,
7.
14,
7.
7, 10, and 7. Okay, so 41. So you can just do 41, 14, 7, right? But I used 10 the other day. Okay, so it doesn't matter. All right. So that's how you look at it. So now this is weekly chart. So if you change this chart to maybe a smaller time frame like daily, or yeah, you see big move. You see this big move now. You see this moving average guided the chart all the way down. Look at the way this one guided the chart all the way up. See this is a pullback. The candlestick came below the moving average, but you see the moving average did not cross. It did not cross this white one. Then it tells you the market is still effectively going up. So most times, some traders, they want to really see the market candlestick break below the moving average, ensuring that the moving average does not cross. Then they use that as a yardstick to take their trade. because they know that it's just like catapult. What this thing is doing is like catapult. When you draw catapult, you pull it back, pull it very well, and you release. So that's what moving average does. This is like pulling the catapult. When it releases, it goes to a very far distance.
I have questions, sir.
Right.
The divergence, does it occur on all the time frames, please?
Yes, sir.
Okay.
It occurs on all the time frame. So what divergence means is every time the market cannot reverse without diverging. So let me put it that way. The market cannot change direction without divergence. For the
Okay.
market to change direction, there must be divergence.
Okay. Excellent.
Okay.
Then the moving average, one thing I notice about it is, isn't it lagging?
Moving average is
One, two,
lagging.
three rule.
Yeah, I want you to also understand
Compared to 1, 2, 3 rule.
Yeah, so I want you to also understand that moving average is lagging, but that lagging is actually to your favor. The reason why people have problem trading with moving average is that people are not adopting. So if you look at this chart here, from here, let me explain this. Look at here. From here, from this low, this market came and break the moving average, right? From when the market breaks the moving average, do nothing until you see that the market has made 2 candles to the left and 2 candles to the right, which is a resistance. So if this is your A, the next 2 candles to the left and 2 candles to the right is your what? Is your B. This is your B. You now put your Fibonacci between your A and your B. This is your Fibonacci. Drop it there. And see from here, where did the market come to? 38.2 level. The market pulls back to the 38.2 level. Can you see this big bullish engulfing candle? So
Yeah.
your moving average can tell you your A and B easily. If the market breaks above the moving average, the next resistance is going to form is your B. And then you will now look for C. Tell me that this market do this and will form this, will draw this here and will left it. And this market comes back like this. When the market hits this level, the market hits 38.2, right? And then I come and I pick trend line and I put a trend line across the eyes of all the week. And then this massive bearish, bullish engulfing candle happens to me. All I need to do is to put a buy right here, buy the market, and put your take profit at what? At 61.8. 61.8 level, extension level. So you put your take profit there. When you put your take profit there, you can use the extension tool and draw your 61 point, draw your distance down to give you 61.8. Can you see 161.8 up there?
Yes.
I don't know if you guys are understanding what I'm doing. Wait, let me do it again. Let me repeat this process.
Sorry, repeat this taking of profit process again, please. How do you get the 161.8, sir?
That's what I want to repeat for you now. Now,
Okay,
if you come to my trading chart, this is my trading chart, right? On this my trading chart, my Fibonacci is already formatted. I formatted my own. Okay. So I formatted my own. So I can say this is A and say B. Okay. So if I say this is A and this is B, the markets come back all the way to C and then it rallies to D. Okay. So you can see my own. You can see all the retracement level and then you can see the extension level immediately. Okay. So in this case, when you just download your trading platform, this one is fresh. I did not alter it. Okay. I did not alter this one. So this is what you will see when you put your Fibonacci. This is what you will see. Look at it. So your Fibonacci can show you retracement level in the direction of the trend. Okay. Look, are you seeing that the values that you are seeing they are all less than 100? The value you are seeing here, 0, 23.6, 38.2, 50, 61.8. They are less than 100. This is the default that comes with the MT4. And that is default because 61.8 is considered the golden ratio. So they really want you to try to trade within this region. They don't want you to really come, down below. They want you to stay in this area between this 38.2 and this 61.8. If you have a reason to trade from there. But now we have put this shows us the retracement level. Now, how do we see the take profit? You pick the same Fibonacci, but this time you are drawing it from the high to the low. Okay, when we drew from A to B. Now we're going to draw from B to A. Take it from B and bring it down to A. Then it will give you the corresponding extension level. Are you seeing it? So this is your 61.8. When the market goes, it will go to 161.8. So if you compress this chart, you will see other levels. Are you seeing 261.8, 423.6? So there are three levels that come with the Fibonacci, three extension level: 161.8, 261.8, and 423.6. So you have it to the upside and to the downside. Okay. So from what we have done, sorry. So from what we have done, this is your 61.8 level, and you see that this market. So if you had follow your instinct that you will buy here, you will put your stop loss below the A somewhere here. Then you put your take profit at 61.8 level here. Close your computer, go and sleep. Come back after how many candles? Let's count. From here to 61.8. That's 36 candles. That's 1 day, 12 hours. In 1 day and 12 hours, you have made 294 pips. See that? 294 pips. For just analyzing the chart like this and going to sleep.
So what about the remainder part to the upside?
That one is not your business now. You go.
Okay.
So what you normally will do is, I want you to look at this chart very well. Look at this chart very well.
Yeah.
Let me remove the moving average. Let me give you the plain chart. Okay, so this is the plain chart. Now look at the chart very well. We explained something just now. I said when the market is coming down, I said this is the ISI, sorry, horizontal line. Please. Okay, let me bring this one down. So with this. So come here. Before the market got to this low, the market came from, watch this, it came from this eye. It came from this eye. It came from this eye. This eye. And then all the way to this low. Right? So now, we have now said, okay, this is our A, this is our B, and this is our C, and the market is going up. Now, as the market is going up, can you see that the market score a point here? By breaking this is one of the eyes now that is coming from the downside, right? So this market break this eye here.
Yes.
Now, and I said when the market break the eye, what is it going to do? Pull back.
Mm.
The market pull back. Ideally, the market will pull back to the back of the previous bullish candle that gave you that resistance. You see it? Yeah. The market will pull back to this point. But I said when the market is pulling back like this, what you can do, if the market has pulled back, the market is here. How am I going to take advantage to continue to trade? I can come here and draw trend line and wait for the market to break it, put a buy here, and you cannot take more of all the profits. So it's really, so there are many ways you make money in the market, okay? And there are many rules that you can follow. So it all depends on you, depends on what you want. Some people will just rely on only the Fibonacci. Some people will rely on these levels as their take profits. So when I enter this market here with a buy, I want to take profit here. I want to take profit here. I want to take profit here. Now, after I take profit here, the market can still decide to go further. You know, can still decide to go further than this place where I'm taking my profit. And if I scroll back in time, there are other levels. Look at it. This is another one. This is another one. So after I take profit in that place, if I compress this chart now, I see I have other level up that I can take profit to. This, I don't know why it's doing like this. It's only compressed, it's not okay. Pull back. It doesn't expand, it only compress. Okay. So there are other levels up there that you can take left that you can use as your take profit. Okay, but if this market now decide to be coming down instead of going up, then we now look at those supports that held the market up. Here are the support. This one, 1, 2, 3, 4. Okay. So that's it. Okay. So the market, we say the market break this one, it will pull back, right? So it breaks it, it pull back the first time, not satisfied, but then it did a more drastic pullback. Now here you can have a problem because when it pull back this little candle, some people would have aggressively sold the market here. And then the market came down and then pulled back again, putting them in loss. Okay? Putting them in, you know, a bigger loss until the market will break this trend line. So the market breaks this trend line, then you can possibly, you know, recover from your error in this place. Okay? But then remember, we have just broken this one. So if we break this, after this, the market will go to the next one. So what we expect this market to do now is to come down, break this, pull back, look for counter trend line breaks, sell the market again. So we can keep doing this as the market is going. And also, so even if, okay, so another thing you can also do, so this is also a low. In this instance, this place is also a low. Why do I call it a low? Because the market has formed a high and then it forms a lower high. So for the fact that the market has formed a lower high, the market can break this, right? The market can break this, and then you can expect the market to pull back to this area before you start set, before you contemplate, you know, taking the set trade. So to avoid you entering here prematurely and being in a drawdown, you can actually wait for the market to attempt to come to this level. Then when the market comes to this level, you look for bearish candlestick formation, look for counter trend line break, and possibly apply stochastic there and see if stochastic is leaving the sell zone. Okay. This is the best stochastic setting that I know. I don't know if anybody have another one, but for me, this is the best. 9, 3, 7. Take it, note it, write it, keep it. 937. This is my best stochastic setting. Okay. So the market comes here and then it's leaving the sell zone, and then the market is falling. So we'll wait for the market to possibly break this, pull back, break trend line, sell. So we just wait. I will continue to do this until we are tired of making money. Okay. Is it clear?
Yes, it's clear, sir.
So this is what I explained. So the market break, then the market can now start doing it. The same way, if you want to come down, you go up, break, score a point, pull back, then it now continue selling to the downside. All right. So everything below here is retracement. Everything above here is what? Extension. Okay, so let's finish this slide now. Our time is almost up. So we're talking about, we're talking about trading consolidation using the 1, 2, 3 strategy. So just for the 7 irrefutable point, this is why I'm bringing all this. Okay, so we can do the same thing on a pivot point. I don't know how many of you have heard of the word pivot point before, but pivot point means it's about the center of the market. So when the market is above the pivot point, the market will naturally try to gravitate to the pivot point. When the market is below the pivot point, the market will naturally want to gravitate towards the pivot point. And every time the market comes close to the pivot point, watch out for these 3 conditions: bullish candlestick formation, bearish market, breaking aggressive trend lines, stochastic leaving the buy or the sell zone. These 3 conditions, look out for them, and you can trade from the pivot point. You can get pivot point from maybe some indicators. You can also get it from maybe some brokers. They can tell you where the pivot point is. Okay. So once you know the pivot point, it's easy for you to do this. I can show you one easy way to know the pivot point is for you to go to Smart Trader. Let me show you Smart Trader. So you come here, you go to Smart Trader. So it's also like Trading View. Go to Smart Trader, sign in. This is my space. So come to chart, and then some of the smart features that you have on the chart. Attention, all live trading rooms are moving to Zoom. Migration will happen on Monday, July 29. Zoom lets you pre-register for sessions, get reminded for them. Okay, very good. All right. So there's a feature here. There's a feature here that will help you mark your resistances and your support. If you look at this now, this is what we call smart resistance and smart support. So let me take them out. Take them out. Take them out. Take them out. Okay. So a pivot point, you can come here and you look for, pivot point, where are you? Not here, not here. Should be here. Yeah, smart pivot point. So if I click on this, can you see that this is a pivot point of this chart, of this currency pair and 4-hour? If I change this currency pair to daily, that pivot point will change. So let me go daily. Okay, let me see. Daily. Yeah. All right. So this is the pivot point for daily. So now, when the market comes from up and gravitate toward the pivot point can act as a support. If the market comes from below and gravitate towards the pivot point can act as a resistance. Look at it right there. The market breaks the pivot point, come back to pivot point acts as a support, draw a counter trend line there, break up that counter trend line, bullish candlestick formation. If you have stochastic here, you should be leaving the buy zone, and then the market rally. So you want to try to make sure that if you are buying or selling from the pivot point, You want it to be very, very accurate. Look at this one. The market breaks the pivot. Yeah, this is one. Yeah, it bought. And yeah, look at the sell. The sell one, it breaks, came back to the pivot point. I want to trade pivot point when the candlestick did not break above the pivot point. So market here came back to the pivot point, but it did not break. It did not close above the pivot point. So aggressive counter trend line here would help me, okay, to join this trade at the violation of the bullish candlestick bottom. And you can see that this bottom, if you put a line here, if I'll just take a line, here's my line too, horizontal line. If I take a line here, put it here, can you see that this is the same place this market came to test here and zoom down? Can you see that? The market just came, hit here and zoom down. That's not the pivot point. The pivot point only gave me an idea that, hey, market can sell from here. So prepare. So instead of me to just rush into the market that it has reached pivot point, I put this extra layer of confirmation. Market has reached pivot point, it has rejected, but it did not give me a. So the candlestick formation it gave me here is this, okay? But because it's not very well confirmed, I didn't take the trade, but I waited for the market to come and test what the previous support, now becoming resistance. And then I put my trade from here and take all those profits, to myself. All right. So with smart trader, you can get smart support, you can even get smart Fibonacci. So this Fibonacci we're talking about, with this smart trader, you can come here and say smart Fibonacci. Where are they? Smart Fib. Okay, smart Fib. You enter. Okay, so I say smart Fib, draw. You see that? Fibo 1, Fibo 2, Fibo 3. What does it tell you? It tells you that the next wave of this market is going to the upside. Can you see how technology can help you to trade this market without stress? Technology. It has predicted for me that the market is going up. So right now the market has created A, it has created B. I'm waiting for the market to come and create C. Okay, so by the time the market creates C, I will look for a bullish candlestick formation, counter trend line break. This is William. Williams act like what do you call it, stochastic as well. So I will see the William, moving from the oversold direction, and then we are going to get a trade. Okay. So this tool is available to you for free on what's it called? On Smart Trader. So if you can go to Smart Trader, you can format the levels here if you want. Okay. All right. So if you can go to Smart Trader, all you need to do, just create an account. It's free. You don't need to pay. Create an account and you can use it. So even if we switch this to something, let's switch to say Euro JPY. Okay, and then let's apply Smart Fib. And since a Smart Fib, come here and place it. So this one is, there's no good opportunity, but let's see this one that went up. Let's see this one that went up here. See here. See the one that went up. This one is already a past market. That's why it's not giving us, something good. All right, so you can make use of that too if you so wish. There are many things you can do. You can even request for candlestick formation. You can come here and say, okay, you want to see bearish engulf. Let's say you want to see bearish engulf candlestick, and you click on it. It will go to the chart and highlight bearish engulf candlestick for you. The ones that are look at it, it has highlighted this one. Look at this one. So there's a bearish engulf candlestick here. You see that? You highlight the one that are bearish engulf for you. Okay, see here, I like this one, I like this one, I like this one, I highlighted this one. Okay, this one, I highlighted this one. You see this one, I like this one, I see. So you see, it will tell you all the one that are, so, I mean, these are tools that are available for you to use to trade this market. Okay. All right. That's for Smart Trader. Then there's one. I will, before I close this class, I will introduce you to one site that will aid your trading with indicators. Very, very important. Okay, so let's minimize this. All right, so you can do that at pivot point. So these are pivot point trading. Then 1, 2, 3 buy. So we can do it from C to D, C to D. So every C to D, you can use these 3 conditions to be buying. You see all the 3 conditions and the stochastic. Okay. The same thing for selling. All right. So once you have the trend line going up or the trend line going down, you can use this, you can apply this 1, 2, 3, 1, 2, 3 condition to it. All right. Okay, so this one is fair enough. And 3, say figure out if you are entering the market on a retracement or an extension. I've talked about this one before. Okay, so you need to know whether you are entering the market in a retracement mode or an extension mode. That will greatly affect the kind of peep that you will make, from the market. So if you are entering on retracement mode, expect a bounce from each of this level. 38.2 bounce, 50 bounce, 17.6 bounce. When the market hit this level, expect that there will be some kind of candlestick formation that will make the market to bounce to the opposite direction. So you want to be very careful when you are doing that. All right. The same thing if you are selling. Okay. Now I talk about make a projected decision whether it's a trading day or a trending day. So this is just a brief analysis of trading and trending day. So Monday and Tuesdays, they are 80% of the time trading days and 20% of the time trending days. While Wednesdays and Thursdays are 80% of the time trending days and 20% of the time trading days. Now, Austin, this will also guide your trading. You ask a question, what's the best time to trade? So now you can see if Monday and Tuesday are 80% trading days, you want to trade more, on the trendy days, because on the trendy days, the market will move 1.5 times its usual trading day ability. Okay. Now, so you want to know Friday. So I've talked Monday, Tuesday, Wednesday, Thursday. So what of Friday? Now, if Thursday is a trending day, Friday will usually be a trading day. And if Thursday is a trading day, then Friday will usually be a trending day. Now, any government announcement holiday, they are all below the average. So they will never, they don't even give you as much move as the normal expected trading day will give you. So usually a lot of activities don't happen on these days. So any government, public holiday, nothing will happen. But
Trying to send it to my this is how I can do it on my system.
Okay, that's what I do now. I want to take a nap.
All right.
okay, so any major fundamental announcement day is usually a trending day. Those are the days that the market will move and they will not. So there's a fundamental knowledge in the market that when the market open on a day, every day when the market open, the market will either go up or go down and then try to come back to the opening price. On a fundamental announcement day, the market will go and will never come back to that opening price. Okay, so take note of that. So these are some of the trading day range for some currencies. So this was to say, so when the market open, the market will usually try to come back to its opening price. You see, prices return back towards the opening price at the end of the London session. So 5 p.m. every day, watch the market, it will always try to come back to the opening price. But if there's a fundamental announcement, it will not happen like that. It will run and will never come back. Okay, so this is a trending day where there's a fundamental announcement. Now, price at the end of the session did not return towards the opening price. Okay, so you want to make sure that this massive move that this market is making on fundamental announcement day, you want to be inside that move. Okay. All right. So, all right, we've talked about this. We talked about this. Okay, active and dead zone. If you want to convert the time to ET, which is the Eastern Standard Time, it usually will line up with 8 a.m. UK time or Nigeria time to 5 p.m. UK Nigeria time. That's the active zone. And the dead zone now starts from 5 p.m. UK time to around 10 p.m. Nigeria time. Okay. All right. So this is how it looks like. So when you see the big, so every day, so this is active zone, dead zone, active zone, dead zone, active, dead, active. So you see the active zone, you have bigger candlestick, while the dead zone, you just have smaller candlestick that are doing something like a range. So you look at the projected trading range, the daily trading range, and see how much pip is left if you still want to enter the market or not. I made an explanation on this already. If the total trading, if the total pips for the day is 50 and the market has already moved 35, do you want to enter the market to fight for 15 pips? It doesn't make sense. So you allow the trade to go and wait for another trade. Okay. And lastly, okay, so this is something that I like telling people. Okay, most businesses at the beginning of the year, which is the first quarter of the year, most of the companies in this world, they are all doing what? They are all planning their businesses. Okay, they're planning their businesses. So now with this, you'll be able to understand which quarter of the year you will trade and make the most profit. Okay, because businessmen are planning their business, they are not willing to invest money between January and March. They are not investing money. They are just doing business plan, trying to know where to put their money. But second quarter, worldwide companies are trying to execute their business plan. That is, buying and selling, importing and exporting will increase, and therefore there will be more trade globally. The same thing for third quarter sometimes. Usually it's the fourth quarter that you experience more of the vacation, but third quarter people are planning their vacation, and you see daily trading range, tending to become smaller in size and in volatilities as the market. While fourth quarter, usually most company will shut down and try to want to set up for the next year. So the best quarter to trade where you see rapid movement is second and third quarter. That's where you see most of the fastest movement in the market. While first and fourth quarter, most people are just making plans for vacation and planning their businesses. So it affects the forex market. Okay. All right. So lastly, you say grade your trade. So you look at your trade, you want to determine if the market is going to favor you, then you need to watch out for these 3 points. Are the candlestick in the up AB boundary? Are the candles above the uptrend line? Did a bullish candlestick formation form? If you tick all this, 40, 20, 30 is 70%. Now, if you have 70%, what it means is that there's a high chance, okay, that you're going to have a good trade. But if you tick this thing at the end of the day, you're having 40 or 50, not that this trade is not good, it's just being a little bit fair. And if you have 40, that means that the market is not, trending at that time. So it's not a good time to trade because that will not give you a good result. So this is also a trading checklist. There are other trading checklists that we can use, okay, but this is just one of them. So just use it to check your trade first. And once you know that, once you get this result, You can use that to determine whether you should execute that trade or you should not execute that trade. All right. Thank you very much for listening to me for this period of time. General question. Do we have general questions before I show you that site I'm talking about?
This
Okay.
presentation, can we have it? Is it possible to have the presentation for today?
No, you cannot have the presentation.
Yeah. All right. Thank you.
You cannot have the presentation, but I mean, one of the material that I already gave to you have everything in the presentation. Everything from A to Z.
Okay.
Yeah, the one that talks about 10 essentials of, where is it? This one. This will have everything in this presentation.
Okay.
Yeah.
That's good.
Yeah. Hello, sir. I'm not in this WhatsApp group that you created for them when you send the materials. If it's possible, you can add me. I've said it before. I don't know why my name is not on it.
Have you sent me your number?
I have before, but I will send it again this night. I'm not in this WhatsApp group.
Okay, send it again. I'll
Okay,
send
sir.
it again.
Okay, then that is one. Number two, sir. After all this lecture, towards the end, I would appeal we do a live session, right? Whereby those things you think you've mentor us, if we can really put them, because I remember this few weeks I lost almost $500 recently. We didn't, yeah. So I don't know what happened to me. It's unlike me. So I don't really know what happened. So I would, after all this, I would prefer we do a live session after all these lectures later on. Maybe we'll find a date or something. But so far so good. I love it. There was one thing you said initially. Anyway, I don't want to take you back, but when you said you start with the weekly candle, something like trying to find among the same seven reputable laws, where you were trying to drag from the daily stuff to fine tune into the weekly. Anyway, it's fine. Mine is just the mentorship level. Because sometimes there was something I was trying to do on on the ABC. I discovered using those small time frame is not helping at all. It's not helping.
So that's why I said something. I said if you see a candlestick formation on the higher time frame, take note, higher time frame, that candlestick formation is a reversal pattern on the lower time frame. And that's why I gave you the exploded diagram. Look at it. This exploded diagram. Look at this red W shape. This red W shape is your reversal. Are you seeing it? See one of the mistakes that people make in trading. People can just see something on a particular time frame and spontaneously they rush into the trade. That thing that you saw on the smaller time frame, on the bigger time frame, go and see what it means on the smaller time frame. That's why we have this. Okay, that's why we have this. So this is ABC. Okay, on a smaller time frame, on a bigger time frame rather. Now, at this point on the big time frame, you are going to see bullish engulfing candle, morning star. It doesn't matter whatever you see. Remember, on that large time frame, the candlestick formation can be maybe one candlestick pattern. It can be two candlestick pattern. It can be three candlestick. Let's say it's a morning star, three candlestick. Those three candlestick pattern now switch to the smaller time frame. Now you're not going to have plenty candlestick that will give you this formation. If you see this formation on the smaller time frame, it means in effect that market has actually reversed. But if you didn't see this formation, that means the market has not reversed. You need to wait. If you see this crown, formation on a smaller time frame, let's take an example. Let's take any example.
When you say crown, you say like higher low formation being formed towards that retracement level, or like higher high. I don't know. You know, when you have the higher low.
I said,
Okay.
okay, let me show you the crown for maybe another presentation. I don't think you started this class with us. Where is okay, let me show you from this one. I'll just rush it there. Look at this. The market goes A, B, C, D, A, B, C, D up, and then the market does A, B, C, D, A, B, C, D down, right? I said when you join these two together, look at it. When you join, this is A, B, C, D to the upside. And then you have A, B, C, D to the first, the market will break the trend line. Look at the market will break this trend line. The market will take out the A. The market will pull back to test the trend line. I say if you join this C, if you join this your A here to this D, A, B, C, D to the upside, then you have A, B, C, D to the downside. If you join the A to the upside and the D to the downside, you are going to have the shape of a crown. This A connected to this D. This A connected to this D. This is the shape of a bearish crown. This is the shape of a bullish crown. I'm telling you that if you are looking at daily and you see a bullish engulf, go to 1 hour and look for a bullish crown. If you don't see a bullish crown, the market has not reversed. I don't know if you understand me now.
Yeah. Noted, sir.
If you come here on a daily chart and you see a bullish engulfing candle, let's put candlestick there. Okay. If you see a bullish engulfing candle, so let's look at this one, bearish engulf. This is bearish engulfing candle. So this one is closed. Let's use something to analyze. This one here. This one is bearish engulf, right? So now I'm saying that if you switch this chart to say 1 hour or 30 minutes, okay, you should see a bullish crown. So look at this chart very well. Do we have a bullish crown here? Sorry, you see a bearish crown rather. You see a bearish crown in this case, right? This is my, let's go back to daily. Let's go back one step like this, right? So we say this is our bearish engulfing candle. So what it means is that this candle, okay, let me put a line here for you. Let me put another line here for you. Let me put it at this bottom here. Okay. So this place now is supposed to give us a bearish crown formation on the lower time frame. So let's go to the lower time frame. Let's go to 1 hour or 30 minutes or 15 minutes. And let's compress the chart and see. So we are looking for A, B, C, D to the upside, and then A, B, C, D to the downside. Okay. A, B, C, D to the upside. Where's the other listener mark? Let's have you remove it. And A, B, C, D to the downside. So look at this. Do you think we have that? Can you see anything like that? Let me draw it for you. Okay. Let me just remove the ray. Let's remove it. Is this a crown?
Yes, it's a crown. It's a crown. It's a crown.
So now when you see this on the smaller time frame, it could be 30 minutes, it could be 1 hour, you see the crown formation is there. It tells you the market has changed direction. Then you connect your top of this crown to the center tip here. Okay, connect it to the center tip here. Now that the market has already moved a little bit, let me push the ray, bring back the ray. So the market is not going to stay in this thing to go down. So what you need is what? You are looking for a counter trend line break here. So when the market break this one now, the market will now continue to go down, respecting the trend line to the downside. So you can now flip this one back to 4 hour or daily, and then you will not stay in the trade for a longer time. Can you see that? I don't know if it makes sense to you guys now.
Yes, thank you very much. Thanks for that illustrations. Crown.
Oh, I'm not done. Okay. So every time you want to be on the higher time frame, what you are looking for on the higher time frame is candlestick formation. If you want to be very effective, you go to the monthly. Look for candlestick formation on the monthly chart. Once you see you don't do anything, just go to the daily, go to the lower time frame like this. See this one now. This is a bearish engulf candlestick formation. Now from here now you can move to the daily and look for the crown. Then you cannot talk of selling that crown. Okay. So every candlestick formation you see on the monthly is a crown formation on the smaller time frame. Okay. So that's why we have this. It makes it easy that you have located your A, you allocate your B, you allocate your C, but you want to see this formation. You want to see this formation on a smaller time frame in order for you to proceed with that trade. Or else you will enter that trade and that trade will go against you, on plan.
Thank you very much. Thank you, sir.
All right. Another question? Okay, so just before we close, if you check some of the website I sent to you, there's one that is called Traders DNA. Traders DNA. Okay. My best is this. Okay. But all of them are good. But if you want to trade with indicators, then come to Traders DNA. Okay. So Traders DNA, all they do is to educate people on how to use indicators. So these are the video. They have a lot of video now, close to like 100 something videos. So each of these video here, their videos are very short. No long, you see them, this 13 minutes, 9 minutes, 11 minutes. All their videos are short, not too long. But they'll just explain to you why you should take the trade. See the divergence we'll talk about now. Okay, let me play this divergence. We just talked about divergence.
Approach with you. This strategy integrates three main indicators, namely RSI, alligator, and hidden divergence, to provide traders with very profitable opportunities. If you want to be successful as a trader, then you must always trade following the trend, avoid trading against the trend, and maintain strict and objective rules. Just like other high-accuracy signals, this signal does not always appear all the time, but if it appears, it means you have found the key to a treasure that you can immediately use to get as much profit as possible. Therefore, you must understand this strategy perfectly because it can be the key to your success as a trader or investor. So, let's break it down step by step. First, we need to identify the trend. The alligator indicator simplifies this for us. If the price rises and is above the alligator indicator, we focus on buy trades exclusively. Conversely, if the price falls below the alligator indicator, we concentrate on sell trades. These simple rules help simplify our trading decisions and maximize our chances of success. The next thing you will look for once you have identified the trend direction is hidden divergences, and you will use RSI for this. So price rises above the alligator indicator, you will start looking for hidden bullish divergences. What this means is that the price sets a low and then a higher low, but the RSI indicator sets a lower low. On this chart, the price forms a higher low, but simultaneously, the RSI shows a lower value compared to the previous low. It is important to be patient at this stage, as future market movements are still unclear. Waiting for a clear entry signal is critical to making the right trading decisions. So let's talk about incoming signals. Once you have pinpointed a valid bullish or bearish divergence, and all the necessary elements have been identified, it is time to wait for your entry signal. But what exactly is this signal? You have several options to consider. First, the RSI has just crossed above the 50 line, indicating a potential entry point. Second, if you see a strong signal candle, such as Marubozu, pin bar, or engulfing which is formed right around the alligator indicator line, this could be further confirmation. When these factors align, you get a confluence of signals, increasing the chances of a successful trade. Once you have identified the entry signal, the next step is to set stop loss and profit targets. For a stop loss, you can set it just below the recent swing low, or choose a method like twice the average true range, or ATR. When using a wider stop loss, targeting 1.5 times the risk may be wiser. However, if you choose ATR twice, your stop loss will likely be closer, so you can target double or 3 times the risk. These decisions help manage risk and maximize profit potential in your trading strategy. Well, now that I've explained the strategy, I'll show you some other examples of implementation in this chart. First, we need to identify the trend. As I said earlier, the alligator indicator.
So I'm sure this is clear, right? So if you go this channel, you have a lot of videos like this, a lot of them, so many. So in order for you not to confuse yourself, you can just stick to one or stick to two or pick three and say, if I see any of these three, I will trade. That will also help your trade entry. So with all that I've taught you, in these few weeks and months, you can adopt an entry strategy from any of these videos. Okay, all these indicators, they are all in your computer. Once you download your MetaTrader 4, your MetaTrader 5, by default, you have all these indicators. Okay, you just come here, watch all these videos. Ensure you watch all of them. My own, I don't just watch them, I watch them and I also download them. Every video on this channel, I've downloaded it. Every video on this channel, I've downloaded it. Every video here, I've downloaded. Every video here, I've downloaded. Every video on no nonsense Forex. I don't know how many of you know no nonsense Forex. Every video here, I've downloaded. This guy, he will teach you on how to build your own strategy using indicators. But the problem with these guys, he has two videos he has to release on a daily basis. He releases a video and then releases a podcast. Okay. Now, you cannot just come to this guy's channel and watch this video and make sense out of it. No. If you want to watch this guy's video, you have to start from the very first video and you watch it in the order of release. So you cannot go and watch 10 and come and watch 5. You will not get it. From the beginning, from number 1 to number 100 is helping you to build a strategy. So you have to watch it in that order. This is called the no nonsense Forex guy. Okay. Then another good guy that I also love is a video is the trading channel. I don't know how many of you know the guy, the trading channel. Okay. Fantastic guy. He has a lot of videos, a lot. And if you watch this guy's trading video, support and resistance trading will not be a problem for you. Look at this. Look at what he's showing here. Are you seeing how that previous support has become a future resistance? Look at that small arrow that is pointing to where the market breaks the support. And then the market pulls back to that support, and then you have entry trade. Most of his videos are like that. Even though I've watched this guy's video in the trading channel, I've also taken his course. He has a course that a paid course, that course that you pay $1,000 to do. I've taken his course. Okay. So if you want to really consolidate on this knowledge, you have to part with some money. Okay, not just now we have taken the class, everything is okay, done. But I can tell you that it's not all the information that I've passed that is stuck to your head right now. It's not all. The only way you can consolidate on it is to continuously explore. And I'm just showing you some of the places where you can do this exploration. And if you take your time to do them, like Traders DNA make life easy for you. Okay. But out of all of them, I've told you that my best is Wise Trade. Wise Trade also has a paid course. Okay. And I've also done that paid course. Okay. Wise Trade, they have one of the best videos in this business. Their videos, there's one of their videos. Let me see if I'll see that video, the end game, Fibonacci. Let me see if I'll see it here. That video was, in fact, that video was something else. Okay. Yeah, this is it. If you are not going to watch anything in this channel, go and watch this video. Compulsory for everybody in this group. Go and watch this video.
Fibonacci what, please?
Unfair Fibonacci trading strategy. The
Okay,
end game. Go and watch it. It was released 2 years ago. This video is very, very powerful. By the time you finish watching it, your whole orientation about this trading will change. You will know where to enter. You will know where to leave. You have a formidable idea how Fibonacci work as well. So
Is
take your time.
this on YouTube?
Everything here is
Yes.
YouTube. Everything I'm showing you is YouTube channel. And I also have them posted for you already. You don't even need to bother. Just come here. See here. They are all here. Just click on it. Just click on the channels. They are on the YouTube, they are on the WhatsApp. I posted it for you already.
Okay.
I've
Some
posted it
people are not on
Sir.
WhatsApp.
Good evening, sir. I think I have issue getting on the WhatsApp. I've sent out my number until now. I've still not been added, so I don't have access to any of these links. If it's possible to add me up out, I really appreciate it. Thank
Where
you.
did you send your number? Did you send it to me?
Yes, it was sent to you last week, so.
Okay, well, just
So I sent our number to you.
okay, drop your number.
Okay, sir.
Okay. Let me see. I think I remember now. I think I have it. You're the one that sent it also, right?
Yeah.
Yes.
Okay, no problem. Don't worry about it. I remember now. But
I just
anyone here
I
that is added, drop your number on the chat room.
Okay.
Just drop your number on the chat room. After once I will add it. Okay. So once I add you, I have to repost. I've reposted this thing more than 5 times. Okay, so that anytime I add new people, I repost them so that they can have access to it. Okay. All right, so I think it's time to call it a day. Thank you for your time. Thank you for staying to this time.
Thank you very much,
This is
sir.
actually the last class. This is the last class for this series. Who suggested that we should do one live training or whatever. I will let you know when we'll do that. But I will do one wrap-up class. Okay, one wrap-up class. After that one wrap-up class, then I can say I've covered at least 70 to 80% of what it takes for you to be able to trade Forex. Now the rest is not left for you. And it's
But
very important. It's left for you. When I say it's left for you, it's left for you. Do it with the zeal, with that commitment, that interest. Forget, don't worry. Sometimes one of the problem I also see is that people want to already go and trade a live account. Don't rush to trade a live account. Start with demo. Perfect your skill in demo. Once you have perfected your skill, you can now come to a live account and start taking trade. If you can grow a $5,000 account in demo consistently, you can do it over a period of 1 month, 2 months, 3 months. and you're able to grow it from 5,000 to say 10 or 15,000, I can tell you for free that if you go to a live account, you can replicate same. But if you go to demo, you make one more, you go, maybe sometimes people will just go and throw large lot size. Not large lot size will not make any difference. The most important thing is consistency. You are able to take that trade every time you are taking the trade, you are making the right decision. Lot size, see, if I'm trading, lot size is not a problem for me. I can decide to do 10 lot size, even if the account is 1 million naira. I can decide to do 10 lot size. Why? Because there's this confidence when you know what you are doing. When you know, see for instance now, look at this chart. If I put a line on this candle here, this is a support, right? This is a resistance. And I put a line, and this market breaks this line and come back to this line here. Are you seeing this pullback to this line? I am most certain that this market is going to buy. To make the whole thing, to make it more beautifully set, the market now gave me a bullish engulfing candle. At that point, bullish engulfing candle from the top of a resistance, that's a strong signal. And to make it more even beautiful, immediately after that bullish candle, it gave me a pullback. This candlestick that you are seeing, this bearish candlestick that closed, is a pullback. I don't need to wait. The close of this bearish candlestick is where I will enter the trade from. I will just put a buy as soon as this bearish candlestick close. I will not have a drawdown. One single drawdown I will not have. Even if I put 5 lot on this trade, it will be to my favor. Do you understand? So when you need to get that confidence, when you get to that level, when you have this kind of confidence, then lot size is nothing. Lot size is piece of cake. You
So
can be
where
throwing
would the
lot
take
size if you
profit
like.
be?
Take profit.
Yes, where
In
will
this,
it be?
so in this kind of scenario, what are you doing in the market when you see this kind of candle in your favor? What are you waiting? No, tell me. You are in trading. I don't want to go by Fibonacci now that, okay, I want to take profit, right? I've given you like 2 ways that you can put your take profit. I say you can use your previous high here. This is take profit 1. This is take profit 2. Okay. But let's say I don't even want to go with this take profit. I enter this market, and this market do 1 big candle, 2 big candle in my, what am I still doing in the market? The next thing is to close and run and take that profit. And if the beautiful, in fact, why you even need to close? Can you see that by the time the market did this 1 candle, 2 candle, it's already very close to your take profit. It's already very close to it. And another thing, see how beautiful this is. Let me just quickly take off these lines. If you want to take off these lines at once, press Ctrl B. It will give you object. Click anywhere. Ctrl A. Select everything. Delete. Everything will go. They will disappear. Okay. So now look at how beautiful this is. This same place that I told you is your first take profit. Can you see how the market hit it? Came back with a strong rejection that somebody can use to say, sell this market. So look at it too. You put a buy and you put a take profit here. The market hits the take profit, take you out of the trade. You sell the market from that place, and the market run down like this in profit for you again. You see that? Because this is a resistance, right? And the market hit this. And I told you, I say, when the market come back to hit the body of the candle, it is called counter trend.
Trend, yes.
This is a counter trend formation. You don't need to think. Just sell at the close of this strong weak candle. Sell the
But
market.
what about a situation whereby, just as you said earlier, one has taken profit when it hits that counter trade and you've
Yeah.
closed your laptop, you won't be able to see the sell formation.
And so that's because you are not there to see, right?
Yes.
You are not there to see. So it's not a problem. It's not every trade that you must take in the market.
Yeah.
Some will pass you, some you will be there to take it, some you will not be
Yeah.
there. It's just like this one that is selling again. Now, even if you look at this one, the same place we are talking about now, look at it. This is your body of your candle right here. Right here. This market just came, hit it, and gave you a bearish engulfing candle immediately. One would have taken a sell right from this bearish engulfing candle. And would have, and by now, the person would have been in profit. You understand? So, all right. If we continue, we'll not go come off for here.
Yeah.
Well, thanks a lot.
Thank you, sir.
All
Thank
right.
you very much,
Thank
sir.
you.
Thank
Bless
you so
you.
much, sir. Thank you so much.
Thank you. Please don't forget to add me. Thank you.
No
Thank you, sir.
problem.
Thank you,
Bless
sir.
you. Bless you.
All right.
Bless you.
Thanks. Thanks, everyone. And have a good night.